Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in live from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will share my personal notes from Jerome Powell's speech, plus the latest on jobless claims and KB home earnings. Today is Thursday, March 23rd, 2023. I am Byron Lazine, and the Hot Sheet starts now. All right, what we've been waiting for all week is what will the Federal Reserve, the FOMC, do with rates? And yesterday, I did personally listen to the entirety of the Jerome Powell speech, as well as the question and answer. I have my own personal notes to share with you. So hit the thumbs up if you are ready for my breakdown. We're going to start with what he had to say about banks first, because that was probably the majority of the Q&A. Then we're going to get into what he thinks about housing and recession. So I've broken it up into three categories. Obviously, you probably know by now that the Federal Reserve did decide to take more action on the federal interest rate, and they increased 0.25% or 25 basis points. They did consider a pause, but there was a consensus to go ahead and move forward with this quarter point hike, which was priced into the market, as we've discussed here on the Hot Sheet. Okay, it does appear that the market is pricing in one more hike, one more 25 basis point hike. Powell did point to that, but with what's going on with banks, he did not say that there is going to be ongoing interest hikes. Remember, last time the FOMC committee met, they did say when Jerome Powell had his speech about a month and a half ago, that they would be having ongoing interest rate hikes. That's not the case, or that wasn't the stance that he took yesterday. Not saying that that's the case. He's saying we just don't know. It may be the case. It may not be. He had a little bit of an I don't know approach to yesterday's speech. All right, let's get into banks. He believes that with the banking crisis, that credit tightening or higher lender standards, basically the same thing, right? Banks lending out less money because of the volatility in the banking sector right now could help the Fed fight inflation, so that they may not need to take this monetary action, right? This monetary policy in increasing the rates necessarily. If that were to happen, didn't say it was going to happen, said that that's a possibility with the scenario that we're in right now. He was adamant, said it a whole bunch. Banks are very strong, very liquid. So Jerome Powell, I thought he tried to do everything he could to instill confidence in Americans that their deposits are safe, that banks are strong. Janet Yellen, who also spoke yesterday, I think they were speaking around the same time, which was a little odd. The minute she started speaking, the markets reacted, started going down. When Powell was speaking, they were basically flat. And so she kind of waffled on that whole thing. That's a whole nother story. She did not instill confidence or the same level of confidence in the banks that Jerome Powell was trying to instill. Okay, so deposits are safe is what Jerome says, but Yellen kind of took a big you-know-what on that yesterday. Okay, SVB, fastest bank run in history, was what Jerome Powell said. So they're going to be looking into that. He's got his vice chairperson running the investigation there. He welcomes other investigations, so private investigations on SVB. They want to find out what went wrong and make the changes. He was asked that question in a number of different ways, answered it the same way basically every single time. Soft landing, when asked about this soft landing the Fed says that we could have with the economy, given the banking sector. He says, and I quote Jerome Powell, I wrote his quote down, "It's hard for me to see how they would have helped the possibility," meaning referring to the banking failures, helping the possibility for a soft landing. So soft landing, less likely, according to Jerome Powell. We'll get into his thoughts around the job market and the recession here at the end. But first, housing. It's what we care about. Hit the thumbs up if you're here for how this all relates to housing. Housing US quote from Jerome Powell. This was within the first, I think, 2 minutes, maybe 3 minutes of his entire talk. U.S. housing market activity remains weak, quote from Jerome Powell. So he believes the U.S. housing market activity is weak and has been weak and remains weak right now as we go into this spring market. Those are Jerome's words. CPI disinflation is coming because of housing. Okay, so he's saying, we know this CPI number is lagging. Housing CPI lags. It makes up a third of this number, and he still believes that probably in May, right, when we get that big reading, we'll actually see disinflation in a much bigger way than we've seen it. Now, he was asked about commercial real estate, okay, and so one of the questions was, hey, Jerome, do you think the next banking crisis is going to be banks that are lending to commercial investors specifically, right? SVB was a bank that was lending to a lot of, tech investors, right? They had a large conglomerate of tech investment, banking clients there. So for banks that are, have large portfolios in commercial real estate, do you see that as the next shoe to drop? And he said no, he doesn't. He thinks that these banks are very diverse and very strong. So again, he pretty much stayed in that lane of trying to instill confidence in the banking system. Now, this morning, Barry Sternlight from Starwood Capital was on CNBC, and he was reacting to these housing comments and commercial real estate comments that Jerome Powell made. I found a lot of them very interesting. I'll go with commercial first, then go back to housing. He says nobody knows what to pay for these office buildings. He says newer office buildings. We're actually in a newer office building right now. We're going live here today from Stamford, Connecticut, and Tomo's HQ. This is a newer office building. Every time I've come here, this office building has been full. There's a couple other newer office buildings right here in the area in Stamford, and my office in Connecticut is in a new office park. Those leases are full. So that's an anecdotal. Let me know in the comments if you're in a newer office building and it's full. We were in just Ken Pozak's in Orlando. That was new. That was brand new, full. And so what Barry says from Starwood Capital is these newer buildings remain full. Let me know in the comments if you're seeing that in your market. Love to know the market and if you agree with that on newer office buildings. But nobody knows what to pay because banks have already tightened lending on offices. They're being advised not to lend on offices. Okay, so they've got to go get alternative financing, is what Barry said, and that creates confusion in the market on what to pay for office. Older office buildings, maybe in less desirable locations, are vulnerable. He does believe overall, because of what the Fed is doing, so he's blaming everything on Jay Powell. He's blaming the FOMC that we will have an office crisis. Okay, he believes the interest rate increases are way too restrictive. He went as far as saying economic crisis is absolutely coming unless they start cutting immediately. Get into what the Fed said about recession in just a second. I want to go back to some of Barry's comments about the overall housing market. Okay, so he says this survey that's used to calculate inflation, CPI, is from 1981, the housing part of it. Okay, and I mentioned here that housing makes up a third of that CPI reading. Okay, so he says this is from 1981. It's completely outdated, and the data is wrong. At Starwood Capital, they've actually done the homework, and rents are up 4%, not the 9.6% that's in the CPI. He said if you put his number in there, inflation would actually be at 2.6 right now. Now, think about that. The Fed just wants to get to 2%. If we were at 2.6 and not 6, I think the markets would be screaming. Everybody would be, really in a positive place. Would be, 2.6 to 6 is it's like nothing, right? So that he says inflation right now is at 2.6. Barry Sternlight from Starwood Capital. Let me know in the comments your reaction to that if you agree or disagree. The CNBC host did push back on that a little bit, where she's like, listen, wages aren't keeping up with the prices that are going up. He thinks wage inflation is good. that the Fed definitely needs to cut. So that was his take. But I did find it interesting, and we've talked about this before. This survey that makes up the housing component of CPI being super outdated. The data lags, so far behind. And so we're all waiting for that. But he believes rents are only up 4%, not the 9.6% that they're reading, and that would drop inflation considerably. All right, let's go to recession. The K's group. Mike just went out, Bobby. All right, I can't hear it in here. You're good. All right, I'm good. All right. Let us know in the comments if that's good, because all of a sudden it went out in my ears. Heavy growth in Las Vegas for new commercial buildings. Now, commercial could be multifamily, it could be a lot of different things. So love to know, and I've got it back. Thank you. I'd love to know, when you say commercial buildings, is that office? Office is the most vulnerable right now. And you're seeing headlines all over the place where it's like, office is going to be that next shoe to drop. That's why Jerome was asked that question. So love to know in Las Vegas, when you say commercial buildings, is that office buildings or is that multifamily? Multifamily, still is pretty strong. It's getting harder to go and do a new project right now because borrowing costs are so high, but existing multifamily, would certainly be strong. And so commercial can mean a lot of different things. Just love to know if you'd like to share another comment on what you're seeing there in Las Vegas and what everybody's seeing in their markets as well. So let's go to recession. Okay, so we talked banks, we talked housing on this Jerome Powell speech yesterday, and let's go to recession. The FOMC is now stronger on a recession happening, right? When we were talking about banks, he says it's hard for him to see this soft landing, and he kept saying that was a possibility in the past. The job market will weaken. He said this 12 times. If he didn't say it 12 times, he said it 20 times. Job market will weaken. When the job market weakens, he was talking about it as if it was baked in the cake, as if it's a foregone conclusion that there is going to be disruption in the job market. So that tells me we're going to see some layoffs. Right now, we're going to talk about jobless claims here in just a second. We have an update from today on jobless claims. But before I get to that, I want to go to a Bloomberg. And we do have Class A office buildings with shopping and dining below. Shopping and dining in Las Vegas makes a lot of sense. But it sounds like the office buildings are doing well there as well. I'd imagine that's maybe some California businesses going over to Las Vegas, but that's just a guess. You would know better than I would. Let me go over to this Bloomberg chart down below. I'll share the chart in just a second. A recession is certain, and so are rate cuts this year. Okay, so a recession is certain. When Jerome Powell was talking about recession and saying the job market will weaken multiple times, it sounded like he and the FOMC are also alluding to what Bloomberg is reporting this morning, that this recession is certain. It's absolutely happening. That's the message from the bond market metric. Federal Reserve Chairman Jerome Powell highlighted a year ago as the guide to tip off best economic troubles in the U.S. So this chart that I'm about to show you is what Jerome Powell said a year ago is his guide to tip off economic troubles in the U.S. It's his playbook. It's what he looks at on if we're going to be going into a recession. The expected 3-month T-bill rate in 18 months' time dropped to 134 basis points under the current rate. That's below the previous record it hit in January 2021. 2001. All right, so 22 years ago, about 2 months before the U.S. economy fell into that recession. Okay, so let's go to the chart here, and you can get all of our charts, all of our sources, everything that I'm going to share here today in the daily download link below. Powell's curve says recession is confirmed. Gap between current future short-term rate signal deep cuts, and that's where Bloomberg and others this morning are saying, hey, we're going to start to see rate cuts because we're absolutely, the indications here show us that we're going into recession. So you see that straight drop off there to the right, and it's highlighted. You can grab that down below if you're interested. Okay. Before we go to where we're at on the jobs, I will read this 2022 quote from Fed Jerome Powell to confirm basically what I just showed you there. Frankly, there's good research by staff at the Federal Reserve System that really says to look at the first 18 months of the yield curve. That's really what has 100% of explanatory power of the yield curve. It makes sense because if it's inverted, right, that means the Fed's going to cut, which means the economy is weak. Okay, and that's what we just showed you. This is what he said 1 year ago, almost to the day, March 21st, 2022. So economy's weak. We could be a couple months and we're into a recession, which means then the Fed will start cutting rates. And maybe we may get that report in May. If Barry Sternlight is right from Starwood Capital, that inflation is actually at 2.6%, not 6%, then the Fed's going to have to do the same thing they've done this time, which is play massive catch up in the other direction and start doing crazy cuts. I don't know. That would be crazy. It just means they keep going too far one way, too far with the money printer, too far with the rate hikes. Okay, so we've got a report today on U.S. jobless claims. Just came out this morning at 8:30. U.S. Jobless claims unexpectedly declined for a second week. So this is countering what Jerome Powell said 12, 15, 20 times yesterday, where he says the job market will weaken, the job market's going to have disruption. Initial applications slipped by 1,000 in the week ending March 18th. Continuing claims were little changed at 1.69 million. Okay, initial filings for jobless benefits fell by the 1,000 mark to 191,000. The expectations were 197,000. Okay, so less jobless filings than expectations. The average right now for the last 4 weeks, the 4-week average was edged down to 196,250 on an unadjusted basis. Initial claims decreased to 213,425. And we've shared these numbers. Like, you can get to 350 on these numbers and be in a very healthy place for jobs. So we're still at a real all-time, near all-time 50-year low for unemployment. So the job market continues to be strong despite what Jerome Powell says is coming in the job market. And here's a chart that showcases that U.S. jobless claims fell for the second week in a row. Initial job claims would be that, if you're watching this, would be that red line, and then the 4-week average would be that black line on top. This is, of course, from Bloomberg and the Labor Department. That'll be down below for you if you want to grab that. Also, yesterday, we had a report from KB Homes, an earnings report, and I'm going to just highlight some of the things, and we've got a couple interesting charts here. KB Homes, new home builder, shared its results for the first quarter, which their first quarter ended February 28th, 2023. There was some pretty significant takeaways. If you're interested in the stock for any reason, they were stock grew to 44.80, up 27% from a year ago. As we enter the spring selling season during the quarter, we began to see an increase in demand. This reflected in part the targeted sales strategies we deployed together with stabilizing mortgage interest rate environment. As a result, we achieved sequential improvement in our net orders in both January and February. Okay, so let's look at what that means. This activity that KB Homes is talking about. I've got a couple of charts that do highlight that. Number one being KB Home, one of the nation's largest home builders, reported a 36% cancellation rate for quarter one 2023. Okay, so you can see that is almost in line with the COVID-19 recession, which was just over 40% mortgage, but it's way below quarter four of 2023, where they're up over 60%. So quarter one looking a lot better than quarter four, according to KB Homes on cancellations. This is a chart here I've shared in the past, the average cancellation rate. I'll drop it back down there today. This is from John Burns Real Estate Consulting, where February, this last month, was 10.8%, which is the same as February 2019. So KB Homes is seeing, a higher cancellation rate than that for the whole quarter. That's all of quarter one, but they've seen it drop significantly from quarter four. So in a housing recession, you typically would see this number going up, not down. But there is still, some good signs in the new job market and demand in the new job market. Now, one thing I want to point out, because I've been on this for a while now, which KB Homes said their average selling price in their earnings report increased 2% to $495,000. Okay, so that's the average selling price for these new homes for all of quarter one. I mean, how affordable is that, right? That's the thing I keep talking about. All these, new construction, new builds. It doesn't help our biggest problem in America, which is affordable housing. That's well off of that median price point that NAR released yesterday, which is $363,000. That's $130,000 more than NAR's existing home sale median price point. In an area with builders, North Texas, slim inventory, yes, buyers gravitate towards new builds, and I don't blame buyers gravitating towards new builds. Heck, you can get a better quality sometimes. Trend should continue across all price points for the next few months. The incentives are too good to ignore, and this is where builders have had an advantage over banks. If we're going to have this credit tightening, higher lending standards that Jerome Powell mentioned during his speech, right? If that's going to hit the mortgage industry, well, these builders do have an advantage there because they can lend direct, so they can kind of buy down that rate. They can lend direct and make different decisions. Okay, so there you go. That's the KB Homes report. I will have those charts down below. Let me just see if there's anything else here that stood out in my notes. It does expect cancellations to continue to fall. They mentioned that on their report. So they believe that the spring market should get stronger, not weaker, for new home builds. They said their average selling price is affected right now by product mix. I just think it's impacted by what they can build and how expensive it is and how hard it is for builders. Okay, so there you go on the builders. Let's take a quick look at where we're at on the 10-year. The 10-year would have been down significantly if Janet didn't get up there and screw up everything that Jerome Powell had said yesterday. Poor Janet Yellen. Can we get a term limit on? Let me know in the chats if we could do without Janet Yellen. It seems like she's been around forever. Okay, the Dr. Fauci of the economy. 3.486 on the 10-year. It's up a tick, which tells me that the 30-year probably end the year, end the week rather. Who the heck knows where it's going to end the year? End the week flat. We dropped down to 6.45 yesterday. That was a really nice drop. We may give up a little bit of that today. Might be over 6.5, but we should be pretty close to the 6.5 unless the 10-year, takes a wild ride at some point later in the day. All right, there you go. We've got a walkthrough coming up today.
Yes, at
5 p.m. walkthrough premiering here on the channel. Please, if you haven't done so already, make sure you consider subscribing. Please consider subscribing to this channel, to this YouTube channel. We go live every single day here on the Hot Sheet. Consider sharing it with somebody who wants a 24-hour look back on the housing market. I'll still be in Connecticut tomorrow, but a different location. And so until then, 9:30 a.m. Eastern tomorrow. Toodaloo.